Good afternoon and welcome to this month's edition of the Elite Funds Maximiser for September 2015. Let's get things underway. The agenda for today is a strategy recap. We'll go through and revisit the actual strategy that is the Elite Funds Maximiser. We'll have a look at the month in review, how the two ETFs performed over that period of time. We'll then have a look at the ETFs for September, which ones are we invested in and why. And also a quick reminder to visit the ETF portal where you can get a copy of this particular presentation and all future presentations as well. First of all, our disclaimer. The content of this presentation or any other Elite Wealth material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. Before making an investing decision based on the general advice presented in any of the Elite Wealth presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, the strategy recap. Remembering that we have a universe of 25 ETFs. Those ETFs selected represent a wide number of individual markets. Some of them are stock indices, some of them are sectors, some of them are commodity based as well. The method used to choose our two ETFs for the month is largely based on momentum. So of our 25 ETFs, we're having a look over their historical performance, if you like, as a measure of potential future performance, and based on that, and again, all our back testing over many years, selecting the two strongest performing ETFs and allocating our capital 50-50 between both of those. The current holdings for the month of August were QQQ, and the other one was XHB. The new holdings for September, we are getting out of QQQ. We are still holding XHB. We are replacing QQQ with SHY, which is basically an ETF that represents a bond market, a short 1 to 3 year bond market. Again, typically in this particular scenario, mirrors the performance of cash as a move to safety. So let's go through and provide a little bit more detail. So Jeff, I'll ask you to just comment a little bit on the month that we had in August there with our QQQ, the Power Shares Nasdaq, and the home builders there.
Yeah. So thanks, Dave. So QQQ, the first ETF, Power Shares Nasdaq. So it's essentially a technology index, tracking obviously the performance of major companies that you would have heard of, like Apple and Amazon and Google, Microsoft, etc.
Yep.
And some non-tech stocks in there as well, to be honest. And the second ETF, the XHB, Spider Home Builders. This is an index, an ETF that tracks the performance of companies that are involved in building homes. So construction companies, engineering companies, but also some like retailers that provide products that you would buy, obviously, for home. So that's intended to catch the activity of the housing market in America.
Yep.
So those are the two ETFs that we had. So we'll just go through how they perform. So QQQ was a very poor performer during the month, and you can see we've highlighted the chart is the last 6 months, and the red box there is the month that we were invested in. The index is performing quite well up to the point where we got in.
Yeah, it was.
You can see it sort of held its ground, drifted maybe slightly lower for a couple of weeks, and then that big dip lower and somewhat of a bounce from there.
Yep.
So it fell very sharply during the month, down 9.2%.
Yep.
As I mentioned, it started off okay, but then a massive sell down, and that was really caught up in the global market sort of collapse in a sense.
Bit of a mini meltdown almost, wasn't it?
It was. So certainly not most of the falls is not attributable to anything specific within the Nasdaq or tech shares or the US market. It was the worst month for global share markets since May 2012, since the sort of the last major European debt crisis. So basically, any assets out there around the globe was sold down quite heavily. So it definitely got caught up in that.
Yep.
Another factor at play, so the QQQ actually performed worse than the overall market, and part of that is that the index had performed so well leading up to the I'll call it the meltdown.
Yep.
That a lot of people would have taken profits, sold out.
Yep.
It would have been one of the first investments to have been jettisoned when the market was sort of collapsing.
Yep.
Another so I would blame most of the fall on the market itself, but obviously not all of it. Can't just put that aside.
Yep.
One of the main factors behind the Nasdaq struggling is the tech heavyweight Apple in the US.
Yep.
Their shares have been fairly weak in recent weeks. Their most recent results underwhelmed the market a little bit, and also more recently there's a lot of rumours flying around about the next iPhone and things like that. So those Apple shares are struggling. In contrast, things like Google and Amazon have taken off, but certainly the ETF and the Nasdaq index itself had a really bad month last month. XHB, our second ETF, was certainly a lot better. What we've got there, obviously, you can see last 6 months again. So it was when we got into it, just sort of breaking out to new highs,
Yeah,
which
it was going really well, wasn't it?
looked quite encouraging.
Yep.
First week was a bit rough, and then went to surged higher.
Yep.
We were sitting on really good gains, and then you can see quite clearly in that red box when that market meltdown was.
Yep.
Little bit of a rebound there. So it ended the month with a 3.5% loss.
Yep.
Started off well before being caught up in that global sell down. It easily outperformed the US and the Australian market, so 3.5% loss for the month sounds pretty atrocious, but that's nowhere near as bad as the damage that was done elsewhere.
Yep.
And ultimately it was one of the better performing assets.
Yep.
What was really interesting is that when we recommended XHB originally, I put up a few charts showing some of the strength in the US housing market and housing activity, and those indicators just got even stronger in August. So there's, from a fundamental trend, the reasons for getting into this are actually even stronger than they were a month earlier.
Yeah.
So just a chart putting all that together, you can see both of our ETFs, QQQ and XHB, finished in the red, but in contrast, the benchmark was smashed. So our portfolio lost 6.4%, which admittedly is a very disappointing result. But for a bit of perspective, the Aussie market, and that includes dividends as well, fell almost 1% more than that.
So the benchmark there being down 7.5%, and the ETF based strategy, the EFM Elite Funds Maximiser portfolio, down 6.5%. So not down as much as our benchmark, but importantly there, QQQ obviously underperforming there fairly significantly. XHB holding up certainly a lot better than either the entire portfolio or the benchmark. But probably an important point at this time, Jeff, just to remind everybody that it is important that you split the capital in your portfolio that you're allocating to this strategy 50-50 between both ETFs.
You don't want to be, certainly if you'd bought at the beginning of the month, if you'd put 3/4 of your money in QQQ and a quarter in XHB, you'd be very upset at the moment. If you'd been lucky enough, just pure luck to have done it the other way around, and had most of your money in XHB, good on you, but that's not really how the system is built. So, look, obviously we don't want to see a month where the portfolio is down 6%, but we certainly don't want to see any more months like the market's had in August. So, if we could outperform the benchmark by 1% a month, that would be spectacular. Obviously no guarantees that we can do that every month, but certainly, it's, for as bad as the situation was, the performance is actually somewhat encouraging.
Yeah, absolutely.
So, we aim to try and make money every month, but sometimes it's just not possible. And when you lose money, you want to lose less than you would have otherwise.
Yep, that's right.
As I mentioned, it was the worst month for over 3 years, and as we've discussed, the Elite Funds Maximiser lost less than the actual benchmark. And again, that benchmark is the All Odds Accumulation Index. So the tracks the top 500 Australian stocks, including dividends. ETFs for September.
The first one there, SHY, the iShares 1 to 3 year Treasury bond, is the one that we're adding to the portfolio, so substituting this in lieu of QQQ. And XHB, the Spider Home Builders, is the one that's already in the portfolio, and we continue to hang on to that one.
What's really interesting is that David and I have been testing this for quite a while, and we've done a lot of back testing. And of the portfolio of 25 ETFs, we rank them from best to worst, and every month we get a list of maybe 10 to 15 ETFs that qualify, that meet our criteria, and we pick the best two. So they are ranked from best to worst.
Yep.
We pick number 1 and number 2. Number 3 is giving off a buy signal, but we basically ignore that and just pick the best of the best. This month, these two are the only ETFs that made the cut. And I haven't seen that happen in a long, long time. Yep. So of 25 very different investments from all around the globe, our scan's going through them and saying, you could only even forget about ranking them best to worst, you could only consider putting your money into 2 of these at the moment. And that's how sort of out of kilter or poorly performing the markets are at the moment. So just a little side fact there, that if you asked us what's the third best one to invest in this month, there isn't one.
Yeah.
Which is quite stunning. Just some basic stats about SHY. So Dave mentioned quite well before. So it's a 1 to 3 year Treasury bonds. Okay, so it's essentially lending short-term Treasuries, which is like investing in a fund that lends money to the US government for a short term, and that's really, at the end of the day, it's basically like investing in cash. Okay, this is considered pretty much the safest investment in the world, and it's no surprise that it's come up on our scan after the month that we've had. It's a very large ETF. It's got a market cap of over $10 billion. It's got quite a high turnover, so it's very liquid. It trades quite a bit through the day. Expense ratio is very, very low, so it's a very cheap ETF to invest in. And you can see top 3 holdings is basically individual bonds, US Treasuries.
Yep. Very good.
Here's the chart of SHY. What's really interesting is that it looks like it sort of rallying up and down, but if you just look at the scale on the right-hand side, will give you an interesting perspective. So the lowest this has been in the last 12 months, is 84.4, and the highest it's been is about 85.4. So this investment hardly moves at all. And it's only it's got a little bit of positive momentum, so it's a little bit higher than it's sort of been for some time, but it's really made the cut as well. Obviously very low volatility, and it's our system is saying you need to invest in this really as an element of safety.
Yep. Nothing
else is worth putting your money into, and this is what we would, if there was not a single investment out there that made the cut, this is where the money would end up.
Yeah, it makes sense.
So just a bit of background behind why this came up on the scan and why this is where we're putting our money at the moment. Obviously, so SHY, it is basically the world's most defensive asset. Not quite, but a little bit akin to putting your money under the mattress, basically putting it under Barack Obama's mattress and saying we hope to get it back fairly soon. So really, this has held its. There's very, very few assets around the world that have a chart like that. Yep. So this is a weekly chart.
Yep.
That the last few weeks would look like that following the sort of market meltdown. So obviously, when the whole world is being sold off, a lot of people, investors, put their money in this as an element of safety. Yep. It's, as I mentioned, it's like investing in cash, extremely low volatility, and we'd expect very steady performance from this over the month. So we're basically not expecting to really make any money out of this ETF, but we're not expecting to lose any money out of this ETF. So it's very much a flight to safety.
Yep.
XHB, so we've discussed this before because we bought this previous month. As I mentioned, it's the Home Builders ETF. It tracks companies involved in that space in the US. market cap of a couple $1 billion, fairly liquid, and a fairly low expense ratio as well.
Yep.
A couple of charts here. So first, the one is the Case-Shiller Index. This tracks housing prices in the US in 20 major capital cities, and you can see that's the last 5 years of data there.
Looks a good chart, doesn't it?
It's a great looking chart, and it suggests you probably should be buying, or should have been buying, US property, and so that's that property. That index is its highest level since 2007, I think. So obviously, housing prices in the US are recovering. When house prices are going up, people build more houses, they buy more furniture and more things for their houses, and more renovations, etc. And just to show that activity, so of house prices translating into activity, this is housing starts. So new houses and apartments being built in the US, a monthly number, and you can see that's at the highest level it's been in 5 years as well.
Yeah, moving in the right direction as well. Good.
So obviously plenty of housing activity in the US.
Yep.
There's the last 12 months of price action, if you just want to comment on that,
exactly.
Dave.
Since October of last year, you might remember we had the market was pretty volatile at that time too, Jeff, and since that particular dip, this ETF has rallied very, very strongly from $28 getting up close to $39, $40. So very good performance there. Obviously, the volatility of the market in the last few weeks, second last candle there being part of that, and a big move to the downward side, sort of intraday, intra-week. But since then, the price has sort of settled at around about that sort of $35, $36 level at this particular point in time. At this stage, it's certainly finding the right sort of support there. But obviously, in the background of this, the fundamentals that you just touched on there, Jeff, are really important, and what's driving its price movement at this stage. So with that behind it, and a little bit of market recovery, then I'd expect this to hold up quite well.
All right, and then just a bit of background from the fundamental side of things. So obviously, the big picture over in the US is they've got extremely record low interest rates, and that's really the main driver fueling the property recovery. House prices at the highest level since the GFC. Over in the US, you can get a 30-year mortgage. Latest figures are about 3.89%. That's fixed, so you can lock in that rate for 30 years, which is lower than what you would get in Australia for a variable rate. And if that was the case, certainly it'd be very enticing to go out and buy property. Housing starts as well are at their highest levels since the GFC. American corporate profits are at record levels, so not only is the housing market performing well, but American companies are making lots of money at the moment, and the home builder companies in that sector are performing very well also.
So the actions for this particular month, we're selling QQQ at market, and we are replacing it with SHY at market. So that's the swap over for this particular month. We continue to hold XHB for the entire month of September. Just a reminder that in the Elite Wealth portal there, once you log in, there is another tab now that we have created called the Elite Funds Maximizer. All you need to do is click on that particular tab, and it will take you into the Elite Funds Maximizer, where you'll see 5 other mini portals, if you like, where you'll be able to go in and investigate the ETFs for the current month. You'll be able to also take notice of the blog once it's updated, the track record of the Elite Funds Maximizer system, archives of previous video and written content, plus the Learning Centre explaining in a little bit more detail about how the Elite Funds Maximizer came to be, the strategy, the past performance, and how to implement the system. So that concludes the Elite Funds Maximizer wrap-up for the end of August for the beginning of September. Just a reminder to keep an eye out for those of you who are in the Elite Investors Club for Jeff's weekly webinars, and for those of you in the Elite Traders Club, the Monday morning weekly analysis sessions. So that's it from myself, David, and Jeff. Have a good weekend, and we will catch up with you very soon.
Thank you, David. Thank you, everyone.